Jake, Lauren, I want to thank you both for taking the time to come meet with me and go over your financial plan and discuss the financial future of your family. I've completed a comprehensive financial plan analyzing all aspects of your family. In this meeting, I want to go over the strengths and some opportunities for your family and focus on a few specific areas of opportunity. First, I want to talk about your strengths. First, you guys are a dual income family, which is fantastic. You have positive annual cash flow, which is also a huge positive. You have established retirement accounts, saving for your retirement, which you want to do in 25 years. I totally think that that is attainable given your income and spending levels. And also, you have received a significant inheritance from your Aunt Barbara. There's also some areas of opportunity. You have the opportunity to refinance your mortgage. You need to save for your kids to go to college. You need to initiate basic estate planning and also create a retirement plan for Harry's. The areas that I want to focus on in this meeting are the mortgage, the retirement plan for Harry's, and the rental property that you received from Aunt Barbara. So first, mortgage. You want me to assess whether it's a good idea for you guys to refinance your current mortgage. So first, you want to see if you pass a couple of the basic ratios that mortgage companies will have you go through when applying for a new mortgage. You pass both of them. First, the housing cost to monthly gross income ratio. Your ratio is 11.45%, and typically mortgage companies are looking for 28%. That is great. And then the total debt to monthly gross income ratio. Your ratio is 22.98%. Mortgage companies are looking for 36%. So again, that is another positive for you guys. Adding in your minimal credit card and auto loan payments, you guys still pass. And so, yes, I do believe that it is advantageous for you guys to refinance your loan. You currently have a 30-year fixed rate loan. You're 6 years into it, and you got when you purchased your house 6 years ago with 9.25% interest rate. Now, interest rates have fallen. Now, a 30-year fixed mortgage interest rate is 4.125%. And it is definitely advantageous for you guys to refinance your loan as soon as possible. You'll see the calculation in the financial plan, but over the life of a new loan, you will save $73,963 if you refinance to the 30-year 4.125 as opposed to keeping your current loan. So I think that is definitely an area of opportunity for you guys to save significant amount of money. Second, you wanted me to analyze Harry's and talk about a retirement plan that made sense for Harry's. You wanted the most flexibility and specifically incentive for your employees to save their money towards retirement. So I think the best route for you to go here is a simple IRA. A simple IRA is a savings incentive match plan for employees. It's for employers with 100 or fewer employees who have earned at least $5,000 in the preceding year and do not maintain another employer-sponsored retirement plan. So for the purpose for you, I'm going to assume that none of the college students that are the wait staff and the bartenders at your restaurant are going to fall under this category. It's just going to be you and the two managers that you've hired that make $35,000 a year. So under this plan, the employees are able to contribute $12,500 of their own dollars towards their retirement, their simple IRA account. Harry's Now there is a small expense for Harry's here. Harry's needs to either, or the plan sponsor Harry's needs to match dollar for dollar 3% of match dollar for dollar up to 3% of what the employee makes. So they make $35,000, 3% is $1,050 for each manager, or you can choose a non-elective 2% contribution, which you would be forced to make if the employees contributed money or did not contribute a single dollar. You'd be forced to contribute $700. So anyways, I believe that the simple IRA is the best solution for your scenario where you want your employees to save their money towards their retirement. It will have a small cost to Harry's, but I believe that it will incentivize your managers to stay with you as longer than they would if you didn't have a retirement plan. Uh, Last area of opportunity I want to discuss with you today is the rental property. You guys received this rental property and you want me to discuss the tax implications of selling the gifted rental property from Aunt Barbara for $84,000. Now, the first step when calculating tax liability in any scenario is finding the cost basis of the asset. So it's a little more complicated here with this rental property, but so the property was gifted to you from Aunt Barbara while she was still alive, so you will receive her original basis, and then she also paid a gift tax on that, so you'll receive a portion of the gift tax into your cost basis. So your cost basis is $36,000. Now, also, you've taken $4,308 of depreciation on the rental property since you have received the asset. So that $4,308 is recaptured under Section 1250, and it is taxed at your marginal rate of 22%. So it's either taxed at 25% ceiling or the lower of 25% or your marginal rate. So your marginal rate is 22. You're taxed at 22% here. So you're going to pay $947.76 on that $4,308 of depreciation. Now the remaining capital gain is long-term capital gain of $48,000, which is taxed at the normal long-term capital gain rate of 15%, making your total projected tax liability of $8,147, or net proceeds of $75,852. Now, you will pay a little bit of taxes if you sell this property, but you mentioned that the property is not cash flow positive. You're breaking even on this rental property, and also the real estate conditions might be deteriorating in the area of this rental property. So I definitely think it is in your best interest to sell this property, take the proceeds, pay the taxes, take the proceeds, and invest the money in a more productive manner, whether it be for your kids' retirement. I'm sorry, your kids' college or your own retirement. I think there's a more productive way for you to use this money. So, last, I just want to thank you guys for coming in and discussing with me the areas of opportunity and your financial plan in general. I would like to take actions on these items that we discussed as soon as possible, as soon as you're comfortable with them. But first, I would like you to take this financial plan home, take some time, read through it, digest the information that I gave you, and become comfortable with the recommendations that I've given you. And I would like to schedule another meeting in the next couple weeks or month and go over a plan of action for improving your financial position. All right, thank you.